Okay, I think in the interest of staying on schedule, I think we'll get things started here, if that's okay. All right, so let's get going here. Good afternoon, everyone. I want to thank everyone for joining us today for our Lunch and Learn webinar, COVID-19 and the economy, where do we go from here? Sponsored by our good friends at Van City. We have a great turnout for today's webinar. My name is Dan Sakaki. I'm one of the managers here at the Richmond Chamber. And before we begin, I'd just like to go over a couple of housekeeping duties with you. Everyone will be on mute during the webinar to prevent disruptions to the presenter. However, we are encouraging questions today, and at the end of Brian's presentation, he'll be answering some of them. You can submit them in the Q&A section at the bottom of your screen. And please note that we do have limited time today, so we may not get to all the questions submitted. And if you run into any problems during the presentation, please feel free to reach out to me in the chat function. All right, so now that the housekeeping is out of the way, time to introduce our sponsor for today, our good friends at Van City. So we are grateful for your support. Bill Cunningham is Vice President, Community Business and Real Estate for Van City and Chair of the Great Northern Way Trust. He is past Chair of the Downtown Surrey Business Improvement Association and Chair Emeritus of Simon Fraser University Board of Governors. Bill has worked in business banking in the Lower Mainland for over 20 years, and he and his wife have more recently become devoted hockey parents to their two energetic boys, spending countless hours at rinks throughout the greater Vancouver region. Good Canadian kids, I see. Bill has always been committed to serving community, and in 2012, he was recognized with the Queen Elizabeth II Diamond Jubilee Medal for community service. Bill Cunningham, ladies and gentlemen, please help me welcome Bill Cunningham.
Great, thank you, Dan. I'd first like to acknowledge that we are gathering virtually today in unceded Coast Salish territory, represented by the Musqueam, Squamish, and Tsleil-Waututh nations. They have been custodians of this land for thousands of years. I'd like to offer our respect to the elders, both past and present. And in this time of heightened awareness, I'd also like to make particular note of Van City's deep-rooted commitment to combating racism and striving to overcome systematic biases. And we publicly support the Black Lives Matter movement. I am Bill Cunningham, Vice President of Community Business and Real Estate for Van City. And given this virtual format, I've taken the opportunity to bring to you a little of Van City Richmond here in my Zoom background. It's an honor to be here on behalf of Van City to present this lunchtime seminar put on by the Richmond Chamber of Commerce. And I really have to applaud the Richmond Chamber for their innovation with this format, given these times. While we are restricted from all being in the same room together, now more than ever, it's so important for the business community to share, collaborate, and work together to ensure we collectively come out of this period as strong as possible. It's times like this that underscore how vital an organization like the Richmond Chamber of Commerce truly is to our economy and our Canadian society. At Van City, we are proud of how our members and staff have come together to face the economic uncertainties of COVID-19. From loan deferrals to zero interest on Visa cards for challenged members, to new initiatives like our Unity Pivot Loan to help organizations adjust. Van City is focused on helping small businesses reopen and stay open. Feel free to check us out at vancity.com/open. Now, I'm particularly happy to introduce our keynote speaker today. As Deputy Chief Economist for Central One, Bryan Yu oversees their economic analysis team and is an author and editor of many of its flagship research reports and updates. He's a trusted speaker at industry and credit union events, and he's also on media's speed dial to provide national and provincial economic commentary. Prior to Central One, Bryan has worked as a housing economist at the BC Real Estate Association and at CMHC. He has a master's degree in economics from my alma mater, Simon Fraser University, as well as an undergraduate degree from University of Manitoba. And when he's not on TV or the radio or in the local newspaper, he also serves on the boards of the BC Paraplegic Foundation and the Canadian Association for Business Economics. Ladies and gentlemen, Bryan Yu.
Great. Well, thanks very much, Bill and Dan, and really to the Richmond Chamber for inviting Central One to today's event. So I think just a little bit of background sort of Central One. Our group is largely really to provide a lot of services towards the credit union system across BC and Ontario. So we support that through various channels such as technology and service such as economics. So today, I think I'm going to be really looking at where we currently are in terms of our group, what we think is the path forward right now for the Canadian as well as the BC economy. I think it's pretty clear that when we look at the current events, there's really only one topic that's currently of mind, at least in terms of a global space, in terms of the economy and where it's headed. We're looking at obviously the COVID-19 crisis. This has turned into, since the beginning of the year, the crisis of our lifetimes, I think, and hopefully that will be the case once this is all said and done. What we do know is that the impact of COVID-19 continues to persist. It's a growing issue, obviously, even as of June 1st. When we look at the numbers, we had about 6 million people who were afflicted with COVID-19. Many of these have recovered, of course. We've had over 400,000 deaths. Actually, the numbers are now closer to 400,000 deaths globally. And the issue is, of course, it still continues to rise. We have seen the rapid spread of the virus leading to largely unprecedented measures to stem the crisis of the COVID-19, largely lockdowns of various cities, regions of the world. You've had India locked down for a while, parts of Europe, some of the original epicenters or the initial epicenters outside of Wuhan, also in terms of Italy, Spain, UK, and many areas were stay at home. The impact, of course, has meant a substantial decline in economic activity. There is some positive news in terms of the spread of COVID-19 that it looks to be easing. So as we sort of walk through where we are in the current COVID-19 health crisis, we are seeing that a lot of these measures to help stem the spread of the virus has in fact yielded some fruit. We are seeing the various countries seeing a fewer cases, at least in terms of growth of COVID-19 on a daily basis. China has pretty much flattened their curve. Canada is working towards that as well. And of course, even in the US, you're seeing the number or the rate of growth or rate of spread also start to slow considerably as well. We hopefully, obviously, that this is going to continue, but nothing right now is certain. But even with this slowdown in terms of the spread, what we do know is that the damage has largely been done. It's been a substantial hit to the global economy. When we look at the economic pressures of the lockdown, what did it trigger? It triggered a big drop off in the number in services. Global travel fell roughly 90% over this period. Since about February, March, we've seen face-to-face services across the globe shutter, just restaurants, retail, as a result of the need for physical distancing. We've also seen the impact, of course, not only on the services side, but also on the manufacturing side. The number of in the U.S., for example, we had all of the major car manufacturers shut down temporarily. All the parts and auto manufacturing in Canada also shut down as well earlier this year. So the overall growth this year is expected to be globally -3%. This is going to be the deepest recession, or it already was the deepest recession since the Great Depression. If we go back to a comparable example here of 08, 09 during the Great Financial Crisis, yes, it was a big shock to the economic system, a financial crisis, but GDP in itself only contracted by 0.1% in the worst year. So this is in terms of the impact on the global economy, this is far exceeding the GFC numbers. The difference, however, again, is that this is a public health crisis. It's not a financial crisis or a Great Recession is driven by excesses in the supply markets and interest rate hikes that drive drive consumption lower. What we are seeing now is that it's a publicly driven type of a downturn to help to maintain the public health system. So you did see all these various closures contribute to this. That also means, however, that the rebound itself is expected to be relatively quick. and relatively rapid as well. We aren't going to get back to where we were pre-COVID-19 in terms of the overall economic activity for the next couple of years, but the actual rebound out of this phase should be relatively strong as we go into 2021. But again, that damage has been done. And what does it mean in real terms, though, if we look at it through the lens of jobs? In the US, for example, we've seen over 40 million people take unemployment insurance. Those are initial claims since the beginning of the beginning of the pandemic. Roughly, this has been equating to more recent weeks about 2 million claims per week. If we compare this to where we were in pre-COVID, it was only about 200,000 per week. So it's a multiple of 10. At the worst point, it was about 6 million unemployment claims. The U.S. unemployment rate sits about 13.3% right now. That's a little bit lower than it was in April, but I think it's been undercounted. Right now, I think the actual real unemployment rate is closer to about 20% in the U.S. at the current time. Similarly, U.S. has seen manufacturing output decline by about 15% since the crisis began, or the pandemic began, and retail and food sales also declined by a similar pattern. So as you can see here, is that the overall economy is in quite a deep funk at the current time. Although, if we blink, it's kind of missed it. The actual recession itself is already over. As much as we're seeing all of these numbers in the rearview mirror right now of a very poor economic April and May numbers, the fact is that these declines are already turned the corner. We're already seeing a uptick in jobs. We're seeing an uptick in retail activity, largely because of the fact that this was the public health crisis driven recession. And now a lot of economies are in fact starting to reopen restart parts of their economy. In Canada, I think we'll move over to Canada. I think it's very similar, obviously a very similar state to what we're seeing in the U.S. as well as in the global market as well. What we do see across the globe right now is there's a lot of difference between what areas or what regions are improving, which regions are doing a little bit better, just because different countries are in different stages of their pandemic right now. Canada has done a pretty good job of again flattening that curve. We've done a good job in terms of people buying into staying at home, staying away from their workplaces, staying out of public in large part, and that has helped to limit the spread. And as a result, Canada is actually starting to show signs that we are also improving in the output and employment. So when we look at COVID-19 in Canada, I think it's, again, that similar type of a pattern. We had the COVID-19, it moved into a public health crisis, and of course, the economic recession. If we look at demand channels through Canada, there were a number here. We can kind of separate this into demand and supply channels of the impact on the economy. We had the initial impacts of the tourism downturn, which also triggered border closures, low confidence in traveling. This also, of course, led to consumer health concerns on demand for services. So even prior to the official sort of stay-at-home recommendations, we'd already seen a lot of Canadians starting to do just that. I think that they were already more hesitant to go to restaurants, more hesitant to go to public spaces. Stay-at-home and work-at-home recommendations, those led to a decline in retail demands, food service demand, and the like. Public transit fell dramatically as a result. And of course, we've also seen demand channels through global pandemic, through the export demand. As broadly a country shut down, they just have less need for imports from other countries as well. Supply channels, this is, of course, is the other one. So we can't really take either of these as a driver because they are interrelated, but there were physical distancing recommendations, which led to voluntary closures of many retail stores. Especially in areas like BC. While some provinces actually had required closure of non-essential businesses, I think BC's were a lot more, there was a lot more flexibility in terms of how much you had to close and whether you could still offer things like curbside pickup as a service. Restaurant dine-in was temporarily banned. Large events remained banned during this period. That includes sporting events and the like. Adding to the Canadian downturn of COVID-19 was that there was also the Canadian markets faced the dual shock of the oil price plunge. Oil prices, of course, have been hammered not only by COVID-19, but also to supply issues as OPEC and Russia earlier this year engaged in a fight for market share that led to a plunge in oil prices. If you look here, this is the West Texas Intermediate for the benchmark U.S. price. I believe in April or so, the exact date is kind of I can't recall the exact date, but we got into about negative $37 territory. What does that mean? It just meant that the holders of these investments couldn't find a buyer for the actual physical barrels. But the point here is that the price of oil collapsed, and for Canada, that also meant that the investment cycle in the Alberta oil sands, the demand for that product, it also spiraled lower as well. So Canada essentially had the dual impacts right now in their economy of the oil price decline, as well as the COVID-19 drop off as well. And with that, though, because there was this public health crisis drove a lot of our downturn in the economy, we also saw a lot of things happening at the exact same time. As these public health measures were announced, we also saw around the same time a number of unprecedented measures from the federal government in order to bridge the expected downturn in the economy and bridge households through the crisis. I'm sure all of you are very much aware of all of these measures, but the federal government introduced the Canada Emergency Response Benefit, which was a $2,000 per month benefit for affected households. There was a Canada Emergency Wage Subsidy for businesses which had loss of 30% of their revenues during this period. In order to cover some of the wages. There was also Canada Emergency Benefit Account, which was an interest-free loan for businesses, with some of it, and with about a quarter of it being forgivable. Adding to that, of course, was the Bank of Canada. They had cut about 1.25 points over that since the beginning of the pandemic. Now the Bank of Canada's overnight rate is at 0.25 point, which is a zero lower bound. There are other monetary tools as well to maintain financial market stability. So the amount in terms of the federal support right now for the economy sits around 100 and, well, probably it's fluctuating every day as we kind of hear more announcements coming out, but roughly about the 150 to 170 billion dollar range in terms of these the various benefits packages that have been announced. Roughly the deficit for Canada right now this year is going to be somewhere about $250 billion. So there's going to be a substantial hit, but again, it's a necessary hit in order during this current time, given the impact on the economy. And when we say the impact on the economy, what we did see is that in real terms, again, the numbers are one thing. You kind of talk about the GDP numbers, but when we look at things like how much has the economy shifted over the past couple of months, we've seen Canadian home sales, for example, decline by 60% since February. You've seen employment down 15%. 3 million people lost their jobs in Canada over this period. We've seen exports in Canada fall by about 30% as well. And what this translates into in terms of a economic standpoint or a GDP number that we are accustomed to is that this will be the most substantial downturn we've seen in history, back to about at least in terms of modern history, let's say 1960. We saw as an economy, we contracted by about 2% in the first quarter. That's a 7% annualized rate. And in the second quarter, largely April, the numbers are going to be probably about negative 12% in actual levels. And that equates to about a 42% annualized decline in economic output for that quarter, completely front loaded. So all of that is largely happening in the March and April period. On the jobs front, again, we're looking at this in terms of the impact and what we're seeing in the actual economy. This is about a 3 million job loss, 15%. And it should be recognized that this is actually understating the amount of the downturn or the degree of the downturn. The number of hours worked fell by roughly 1/3, so about 28% from the peak. in terms of the actual number of, that's the people who employed, but also the people who are unemployed, but also those who were employed, but they really had 0 hours or very few hours because of layoffs or shutdowns or partial shutdowns of their organizations. And when we look at this as a number of, if we include all those people, we call the numbers who are also various people who are looking for work, who weren't in the labor force, they still wanted to work. Roughly 35% of the Canadian workforce or Canadian workforce was underutilized at this point in time during this March and April period. And of course, again, it's largely a national type of an impact, given that it's a global pandemic, and a lot of the provinces really implemented very similar types of strategies. There were some provinces who did not do much in terms of lockdown, whether it's because they had relatively few cases, like a lot of the Atlantic, fewer people, fewer cases, more spread out perhaps. Some Manitoba have fewer restrictions as well. But again, in areas like Quebec and Ontario and BC, where we had relatively more restrictions just due to, number one, potential more inflows of international visitors, more movement of people, various factors. We also saw about 15% declines in unemployment, in the employment numbers. Quebec had about an 18% decline, largely because they moved relatively quickly to actually shut down a lot of the non-essential components of their economy. When we look at the areas like who or what sectors were most hit, I think a lot of you are again very aware of these, at least if not the actual numbers, at least anecdotally, and what you're feeling in terms of the market and the business environment. The vast majority of these losses came in the areas of A&F. So the A&F is accommodations and food services. So these are the restaurants, these are whether takeout joints, all those types of areas, and also hotels. So the tourism side of the economy would be factored into these numbers. A second one would be the trade numbers as well. When we're looking at this through the lens of the trade numbers that we're seeing, this is the retail trade and wholesale trade. So this is one of those components that was also hard hit, as there was a lot of voluntary closures of businesses as a result of there being less demand, more people working from home. There's no real reason to maintain operations in many cases because customers weren't flowing into the doors at this point. There were, however, already another wave. So this is the early numbers, February to April. We also saw most of these service sector losses were in the period of in March. We did see some increased losses in construction and manufacturing when we headed into the April period, suggesting that there were some secondary impacts, whether it's through loss of sales, loss of demand in these regions. Unemployment rates across Canada have also climbed rapidly. If we look at the unemployment in areas like Quebec hit up 16%. The BC numbers are now at about 13.5%. And these would be, again, some of the highest numbers on record for Canada for when we're looking at the overall peaks of unemployment rates. So an area that we're kind of watching very closely at this point, of course, is a lot of the data that we're seeing really relates to households, whether it's labor markets, and that's where we're getting a lot of our information from because it's the most timely at this current time. But when we look at some of the interesting factoids coming out of the business side, and I think this is, again, your group would be would probably be in these numbers in large part because a lot of these are based on services or on surveys of businesses. What we did see was that there's been a massive decline or a massive impact on Canadian businesses at this current time, and it's across the province, across the country as well. This is numbers from the Canadian Chamber of Commerce and Stats Canada, but some of the numbers that we've also seen elsewhere include the Canadian Federation of Independent Business. And a couple of interesting, I guess, facts that we've seen, at least from March and going through to May, has been that in March, about 77% of businesses were either closed or partially closed during that time. their small businesses, not the larger businesses that remain, like Canadian Tires and all those kind of Home Depots. Those all remained open, but 77% of their members surveyed were partially closed. This fell to about 62% in the May numbers that they reported. About 38% were actually fully open in May. But what we can see here is that there was a large impact. These numbers here are for the first quarter of the year you're seeing. These are the proportion of businesses that noted revenue loss in the first quarter. As you can see here, the numbers are somewhere around close to about 75% note at least some revenue loss. And if we look at the numbers who had 30% or more revenue loss in the orange, you see here it's closer to over 40% during this period. We use 30% just because the policies that were implemented by the federal government in order to obtain certain benefits was dependent upon a 30% threshold at the time. But you are seeing there was a very large decline in a large hit to firms in terms of the revenue loss. And if we look at this through the types of firms, very similar to what I showed you before in terms of the losses of by sector in terms of the employment. While these sectors like accommodations, food services, arts and entertainment and recreation saw the biggest hits, they also, of course, drove the largest layoffs as well during this period. Other areas, transport and warehousing, tied in large part to things like trade, and again, retail trade also very high on these numbers. And when we look at the impact on firms, we do know that this unprecedented situation in the business environment did cause a lot of businesses to make hard choices during this period, whether it was reducing their staff hours or shifts, or also layoffs in terms of the layoffs for their staff as well. In very minor cases, relatively few of them reduced salaries or wages. It was almost all or not, right? You either went to full reduction of staff and labor, or you didn't. That was kind of the two choices I think a lot of businesses made. And we also saw a lot of businesses pivoting during this period. And this is one of the interesting things that we can't really quantify at this point, but we did see a lot of businesses either shifting their way of delivery if they were still open, whether it's on the food services side, shifting towards either takeout if they were mostly dine-in restaurant, or pre-packaged foods that households can make on their own. But again, trying to drive revenues in order to cover some of their fixed costs that they still incurred during this period. And there's been a lot of difficulty. I think that some of the numbers we're seeing in terms of the businesses is that 32% of businesses, according to the CFIB, have already fallen behind on their payments. So it's a very difficult situation. And of course, businesses have sort of pivoted in order to minimize some of that impact. Here in BC, I think we've seen some very similar economic trends as well, though. And it's quite interesting. I think there has been some significant differences between BC and the rest of the country. In one aspect, employment was very similar. We lost about 15% of overall jobs since February. MLS sales are down about 50%. Food and beverage sales, the numbers I saw for March, actually this was pretty early in the cycle, was already down by about 30 to 40%. So it's a big drop off in food service type of activity. Well, one area that we actually didn't see as much movement in was exports and even manufacturing. Relatively modest declines in exports. So I don't have the exports here, but the exports fell roughly about 18%, I believe the number was, compared to a 30% drop in Canada. The big reason is the type of products that are sold. When we look at Canadian exports, those losses were largely driven by energy products, as well as motor vehicle parts. While in BC, the losses were largely in some cases resources. Forestry was already terrible last year, so there wasn't much more to lose in terms of the forestry sector. Agriculture also remained pretty steady, as well as demand for food still remained quite solid across the board right now. But one of the areas, of course, that is likely driving the fact that Vancouver BC has still performed relatively poorly. When we're talking about it from the grand scheme of things here, is that we have a very high exposure towards the areas like the tourism. When we're looking at the hotel occupancy rates, I think they're sitting roughly here at about 40% in terms of the numbers that are available. Those numbers are going to fall into obviously April and May, and if we look at it through the summer months, it's going to be terrible as well, given that the borders are still closed. But again, and when we look at it through the lens of the provincial economy, the hotel sector or the tourism sector is about 10% of our economy. So this has been, I think, a key factor in terms of contributing to the significant downturn in the BC economy as well, despite the fact that we're not as heavily invested in areas like autos and energy, which is impacting other parts of Canada. In Metro Vancouver here, just as a comparison here, because generally Metro Vancouver has actually has fared worse than the BC economy as a whole during this period. While BC is down about 15% in employment, Metro Vancouver is down about 18%. Unemployment rate in Vancouver right now is about 14.1%, compared to about 13.5% in BC as a whole. And the employment rate is only 50% of the working age population is in fact working at this point. Given the last numbers that we've seen, compared to about 64% prior to the COVID-19 period. A lot of service jobs have been lost, and I think that's kind of where we're sitting right now in the overall economy. And this is just for information, just shows what I just said, that Vancouver, which is the red dot here, has a higher share of its economy based in accommodation, food services, some of the harder hit areas of the economy. So that's kind of a lot of the bad news I want to go through, at least for the front end, because there hasn't been a lot of good news over the past couple of months. It's been quite a challenging period, and really unprecedented when we're talking about it through the lens of where the economy is. And when we're talking about next is going to be where we think the economy is going. And frankly, I think there's a lot of uncertainty right now. Any idea that anybody has a crystal ball of where this economy is heading? Well, here's what they're working with right now. It's completely broken, and it's a very difficult time to forecast. And I think we all recognize that. What we're looking through is the lens of different scenarios in large part. We will give you, at least in this session, I'll give you what my base scenario is at the current time for economy. Partly, some of you may think it's going to be a little optimistic, but I think that we're probably headed in this direction. There are going to be risks, however, as we move forward. One thing to note, I think I did see a little question pop up. Are you about how we can say the economy is, that the recession itself is over? I think we need to be careful about whether that the economy being weak versus it being in a recession. What I'm saying here is that the technical recession is over. That's where actual output declines, the peak to trough period. And when we move out of that is considered the end of a recession. The fact is that what we've seen in the last couple of months has been a massive cratering in the economy. It's been something we haven't seen before in terms of a drop off in economic activity. However, but because this was a public health crisis, and by decree, government-driven closures of the economy, we should expect to see that as those measures are lifted, as we've seen in BC and we've seen in other parts of Canada like Manitoba, the Atlantic as well, that will just by extension drive an increase in economic activity as we move forward through late in the second quarter and through the second half of 2020. When we look at business confidence, what we're seeing is that the numbers for business confidence are in fact improving. The numbers in obviously sort of the March-April period were horrible, even through early May. But as the measures in place from the provincial and federal governments came into play, and the signs that economies were in fact reopening, that of course has created some greater levels of optimism from the side of businesses. They're still in a very, they're still quite pessimistic. Let's be clear about that, is that many of them, think about 40% of businesses, I think, still are still saying that business conditions are bad, but it's, that's less than it was 2 months ago. We're also seeing some signs that the major weakness in spending on the part of retail client or retail retail consumers looks to be also improving as well. So these numbers were from in April, so they were still quite low. We look at dining numbers; they were well below their pre-COVID-19 levels. You look at the blue dining number is closer to about 70% down, I believe. Health, again, at 50% down in terms of these numbers. But if we look at the more recent numbers going through the end of April, and there's some more updated information here from various financial institutions who are looking at their anonymized data from credit card spending, you are seeing a movement back of retail spending to pre-COVID levels. Still, probably down about 20, at least 20%, but better than it was when it was down 30, 40% earlier in the COVID-19. And if we translate that into business conditions, that does mean that there's more retail spending occurring for businesses in the economy. And we are, again, this is going to be a very short technical recession. We think that the bottom of the economy actually came in late April. The May numbers for employment are already up. In BC, we gained 43,000 jobs. Of course, we lost 400,000 the 2 months prior. But again, it's that turning point that we're looking at here. It is a very deep canyon, however, to scale back out of. We are seeing across Canada right now staggered phased openings across the country. Very uneven. BC's phase 2 is May 19th. There are still the physical distancing measures required in many sectors. And requiring a PPE or a personal protective equipment in some cases for when you get your haircut or going into certain stores. There is ongoing restriction on travel and borders and required quarantining for inbound individuals. And of course, large public gatherings are restricted. So a lot of these factors that are still in place during this modest reopening period of the economy and growth. We do expect to see that the second quarter will mark again, that will be the worst of this, and it's going to be a relatively gradual, but again, some pretty strong. You'll be starting to hear a lot of strong growth numbers in the third quarter and fourth quarter, but we'll still be well below where it was in the pre-COVID-19 days. We don't think the economy will get back to the sort of the early 2020, 2019 periods until possibly into 2022 at this point. It's actually it's going to be a long slog. There'll be a lot of questions as the rebounds. We are going to be automatically the sectoral capacity is going to be automatically lower as restaurants require less capacity in their restaurants or less usage of capacity. You're going to have retailers who need to maintain social distance or physical distancing within their stores. So again, fewer sales. Consumers, are they going to be confident enough to engage with the economy? These are all constraints. We also think that certain sectors are going to remain quite weak. Accommodations and food services, it's going to be weaker. And we're also looking at things like work from home. That's going to be another factor of that if people aren't out and about at their offices, they also won't be buying things in the daytime near their places of business as well. We do think the Bank of Canada, however, will keep their rates this low through 2021 at the current time. BC, very similar. We actually have a little bit less of a contraction, about 6.8% versus more than 8% contraction in Canada for 2020, and we're expecting about a near 5% rebound in 2021. There are some aspects of the economy which are going to be different, namely that we have a couple of the impact of major infrastructure projects in BC, LNG, a lot of construction is still underway. Those are going to provide a boost, but I think it's that retail side, the consumer side of the economy, which will remain quite weak through 2021. But we are, again, like I said, we are in recovery. We have a long way to go. If we look at our current employment numbers in red here and compare that to past recessions, again, the quickest, deepest recession we have seen in modern history. And we're now looking at how quickly that we can actually rebound out of this going forward. So in terms of our again, our I'll probably provide this, but basically it's a constrained reopening, staggered, really summarizing what I just mentioned earlier, that there are going to be some areas that are going to be more hard hit as we go forward. But one thing to note at the very bottom here is that many businesses may not survive this due to low margins. Some of them came into COVID-19 with a very constrained profitability. Certain sectors have lower margins, and while they reopen partially at the current time, there's a question of whether or not if physical distancing and these types of measures are maintained over time, how many businesses themselves can survive 3, 4, 6, 8 months of this type of constrained activity. We are also thinking that there's going to be a fear of a second wave of virus, because there likely will be one to some extent, and that will hamper investment as well. And one of the issues, I think some of the Stats Canada data we've seen is that how long are businesses able to remain fully or partially operational with distancing measures in place? There's a lot of them will. If we look at the sort of the right-hand side, I think a lot of these are larger organizations. Also, those who are more service-oriented allow work from home. Those types of businesses. But when we look at the sort of the middle point, there are a lot of businesses here that can only last 1 to 4 months of either full or partial distancing. So that's going to be some area we're going to be watching as well, to understand going forward, is that how many businesses can survive this type of environment, and what type of businesses will thrive or be able to essentially enter the market under this type of environment as well. We're also looking through the population numbers, and things to look at as we're going forward is that population is likely going to be quite weak from 2020, 2021, just due to border closures themselves. The fact that right now for new immigrants and student and visas to come in, those paperwork had to have been done by March 18th. So there's going to be a period of weaker migration flows, and that's going to impact the not only business expansion, but also overall housing markets expansion as well. The housing aspect of the economy has been really quite interesting right now. Most people would expect that housing would free fall in this type of a scenario, just due to a lot fewer sales. We did in fact see 50% drop off in sales from pre-pandemic. However, we've also seen a lot of people pull their homes off the market. There's actually been very little move in home prices over the last couple of months, as I think everybody's taking a wait and see approach. Right now, there's been a lot of forecasts out there, that some from CMHC, for example, that are predicting an 18% decline in prices. I don't think that the market really necessarily warrants that at this point. And when we look at the sort of the overall supply environment, and the fact that we are going to see a rebound in overall economic activity, and sales activity looks to be picking up as well, I think there is some downside pressure, but I think they'll be limited towards the 5 to 10% range as we move forward right now. My concerns here is really about probably in the fall period, when we start seeing sort of the impact of the second wave, or the impact of more businesses laying off individuals as demand doesn't come back as strongly as businesses hope. In terms of the risks, I think that right now the risks are weighted to the downside, and it's all really going to be contingent on the epidemic curve. We are basing our forecast on that we are going to see this gradual rebound, relatively, I would say, pretty vigorous in terms of the growth rates, but it's going to take time for us to get back to where we were. The risk right now is that we might have a much deeper second wave than anticipated. And if that were the case, that could bring back some of these distancing measures. That also would lead to the risks that businesses who survived the first wave and reopened won't necessarily survive a second wave of closures. It may not be economic feasible for them. We'll also have potentially consumers who are a little bit more hesitant in those types of scenarios. So right now, that's our second scenario, that we do have that ongoing a weaker scenario into 2021. But right now, again, being a little bit optimist here, is that I don't think we're going to move in that direction. I think at the very least, public health authorities will have learned quite a bit after this first wave, and have sufficiently planned for that second wave as we go forward. So I think in summary, I think that, yeah, we're absolutely in a unprecedented situation of the economy. We haven't seen a contraction of this type, in terms of data, in terms of going back to 1930s, really. But it will be deep, but quick. It's going to be, we've pretty much moved past the worst of this downturn, I think, at this point, and we are seeing the economy open back up right now, and that is driving the job growth already in the numbers that we're seeing. And we would expect that to continue as we reopen parts of the economy. But again, but we can't expect that this is going back to normal. There's too many headwinds right now, whether it's the distancing factors and whether it's the consumer confidence, which is going to be impacted by this. And also, some people who have lost their jobs just won't be returning to work as much as they hope at this point, due to the broader global weakness in demand. And again, this is a permanent loss in economic activity that is really going to take years for us to make back. So it is going to be a tough, at least a tough year. But I do think it's going to be getting better as we move forward over the next through 2021. So that in its nutshell is the presentation, our current outlook for the economy. I think I'd be happy to open up for questions as well.
All right. Well, thank you very much, Bryan. Can you hear me right now?
Yes, I can.
Okay, perfect. Bryan, thank you very much for the valuable insight into the economic impact of COVID-19, and what we can all expect is the restrictions lift. Things are starting to get a little better. We're talking about in our office, and we're starting to hear it from our businesses that things are starting to shape up and look better. We do have a number of questions that have come through, and I know that you had mentioned on one of your slides about how there's been some assistance from the federal government. Governments actually at all levels have committed huge sums of money to help residents and businesses get through this pandemic. Clearly this can't be sustained for long periods of time. What happens when this government assistance stops? You talked about wave 2 hitting, and what's that going to look like in terms of what the government can do? How do we manage this massive debt load moving forward?
Yeah, I think that there is going to be that question mark as we move through 2020, especially near the end of the year. Right now, a lot of the measures are expected to roll off probably August. Deferrals of mortgage payments and things like that will also be, I believe, it's a 6-month deferral, if I recall, in some cases. So there is going to be this potential that these programs will end, and some consumers are going to be sort of hit in terms of their finances. One thing to note in terms of the labor market is that the majority of those being hit by the COVID-19 in terms of taking these programs, or in terms of the labor market, has been in that accommodation, food services, retail markets, retail employees. So at some level, it's kind of there's a certain segment of the population which needs more help, which is lower income, the lower paid individuals in terms of the workforce. It's just the numbers that we've seen. I would think that if this does continue, if we move back into August and we still don't have a sufficient amount of rebound, businesses haven't hired as many as it's expected, then we would see some extension of some of these programs, especially in terms of the response benefits. And this does mean, of course, that the deficit situation will be more substantial, and that will be. But it's kind of the offset of that is, if we didn't have these programs, then things would be a lot worse, because people can't make their bills, will default on their potential mortgages or rent, or can't make their rent. But we would expect to see some higher taxation going forward, I think, to offset some of this, and part of it just being some of the debt being internalized through higher growth in the future.
Perfect. Thank you, Bryan. We've had a couple questions come in regarding supply chain interruptions. And one question here: for companies who have experienced supply chain interruptions due to lockdown around the world, and who are interested in bringing part or all of their upstream sourcing and manufacturing activities back to Canada, do you have any advice for them?
Well, in terms of what they can do, I don't have any advice on exactly how you would do it, but I think that in the short term, I think we're moving back to sort of this global supply chain, something similar to pre-COVID. It takes a little bit of time for us to actually shift those types of supply chains. But over the medium long term, I think we're going to be seeing the shift not necessarily to Canada, but some of it maybe towards our North American markets and other Asian markets as well. I think there is going to be a push to diversify supply chains significantly as we go forward, and that could benefit other countries like whether it's Vietnam or Mexico, or even parts of the U.S. as well. So it's going to be. I do think that there's going to be a change right now, and especially as we are looking at it through the lens of sort of the global environment where protectionism is actually ramping up again. I think this is going to be that longer term shift, but I can't say exactly how you would do it, but I would expect that would be sort of a trend that we're going to be seeing as we go forward.
Awesome, thank you. When you start off your presentation, you showed us some stats that are coming from south of the border. And one of the questions that came in, it seems like Canada's response to this pandemic from a public policy and health perspective has been preferable to the US. Are you seeing signs of more prolonged economic downturn in the US? And if so, how can we expect that to affect Canada?
Yeah, I think that we are watching to see how the US is approaching this, because they've already reopened a lot of states have reopened at some part. But we're also seeing, however, the COVID-19 cases rise dramatically at this point as well in the US and some of these states that have reopened. It's going to be a question of whether they choose what policy they choose. At the end of the day, I think that there is a choice that governments are making at this point. It's a trade-off between the economy and people's lives at the end of the day. I think that's what we're seeing right now. And so we don't know exactly what the US will do. I do think that in the long term, though, if you don't work to limit the damage it has on the public health system, it actually creates a longer term damage for your economy. So I think the US could grow at a relatively quicker pace if they don't do the lockdowns, but at the same time, that's going to be a choice for them to make. And the Canada economy is going to, of course, also be somewhat dependent upon that. So if the US does grow at a faster pace, we'd actually somewhat benefit from that as well. But again, it's Canada is, we view Canada as coming out of this, so it's going to be that relatively slow, that graduated pace as we're seeing different areas of the economy reopen.
Perfect, thank you. We've also had a couple questions come in with regards to real estate, Brian. What short and long-term impacts do you see COVID-19 having on this sector? As you know, in BC, strong real estate sector has been a real driving force here.
Yeah, so the short term, I think that we are looking at a period of decline in terms of pricing and low sales volumes this year, and into next. I think we're going to see, again, similar to the rest of the economy, April and May are really going to be the low points, and we're going to see a rebound in overall sales volumes as we move through the year. But sales volumes are still going to be down, in my view. If we look at, depending on which metric you're using, either MLS sales could be down about 20% this year. Prices, we expect that to also falter as well, anywhere from 5 to 10% in terms of pricing. I think it's going to be dependent upon how many households feel that they need to list their homes. A lot of it's going to be supply driven. There are a lot of investors, especially the Airbnb cycle, some of the multifamily unit potentially are maybe listing their property. So I'd be a little more concerned that multifamily is going to take a little more of a hit as we go forward. The other aspect is the population, which I discussed before, is that over the short term, at least, population is going to be a softer part of the story, because whether it's just that there's that we're seeing borders still remaining closed, people are a little more hesitant to actually make any global travel, as well as some issues in terms of the paperwork for admitting new residents. Also, the number of students, if they're dealing with the short-term aspects of online learning, do they even need to come? That's going to be another question to be asked. But that being said, when we move past this, I still think that population is still going to be a strong driver of this region. If we think about it through the lens of how well, if you think about it through a COVID lens of how well is BC actually kind of approached it, I think it's in a pretty good story there. When we look at social unrest, global unrest, again, that's another issue that Canada does look very attractive, whether it's from what we're seeing in abroad or even south of the border.
Great, Brian, thank you. As we talked about earlier as well, we talked about the different provincial and federal governments and their assistance they've given out to individuals and businesses. Of course, that might lead to questions about our deficit in the future, increasing debt loads. Do you believe governments might need to look at increases to things like taxes like the PST and the GST to help cover these sorts of debt loads?
I think there's going to be a combination. Number one, when we get past this, there's going to be a period of belt tightening. I think the federal government is absolutely, and provincial governments. I'll say the federal government first because, I think given that they're really driving most of the spending and most of these policies, they're going to look at a period of belt tightening after this is all said and done to sort of. Because that will be the prudent thing to do. There's also the likelihood there's going to be I would say, temporary taxes potentially to, maybe it's a COVID tax or something of that nature that's really used to just address some of the shortfall. Provincially, I think that, we are, the province, I think they've really only allocated roughly about $5 billion to this. So it's just a good number for the province. I think it's still a large number, but BC in itself has a very good, has a very strong fiscal standing. So there's no operational deficits, relatively low debt. So I think that as a province, it could easily weather this and largely just internalize it over the longer term. There is going to be an issue in terms of the revenue hit and due to a smaller tax base as people still remain unemployed. But overall, I would expect to see some minor tax increases over the next couple of years to offset some of these, but also belt tightening and a growing economy doing a lot of lifting as well.
Perfect. And I think we have time for one more question here. If K-12 education does not fully open in September, Brian, what impact do you see this having on our economy?
Yeah, that's a interesting question because it speaks to the type of recession that we're also seeing right now, which is one that is more heavily weighted towards service-oriented jobs, which predominantly also still are affecting females. We're also seeing the fact that if you have no K-12 or kids aren't really in K-12 or aren't in a normal state, that means people have to stay at home longer. And again, in many cases, that has fallen on the shoulders of females in the market as well. So they're calling this a she session for a reason because of who's more heavily impacted, and that's kind of where policy needs to go to as well. It has to look at how do we safely reopen schools? How do we safely ensure that there's childcare? Because fundamentally, if not, you're going to need to have people at home to take care of these children. And I think that is a risk to the outlook that for some reason or another, schools aren't operational at the same extent as they were last year. And it could look something like it is now, but that also means that you may require flexible work arrangements. Maybe people are working at different times of the day, for example, as a way to sort of offset it.
Thank you, Brian. I know that this topic affects everybody here, and I know that we can go on for another hour on this topic very, very easily. But in the interest of keeping to our schedule here, I would just want to thank you very much for sharing all of your amazing information with us today. I can safely say that I'm sure everybody here has learned something. So before we just part for the day, I want to just let everybody know about our next upcoming events at the Chamber. On June 19th, we are hosting a town hall with our four local MLAs. All Chamber members are also asked to attend our June 30th annual general meeting, also on Zoom. And if you'd like to join us for either of these events, please visit our website to register. Thank you once again to Bryan Yu from Central One and to our amazing friends at Van City for their support for this event. And lastly, I want to thank all of you for joining us today. We wish everybody a great rest of the day, and thank you for joining us today.
Thank you.
Thanks, Dan.